In this video, we'll take a closer look at KLAC Corporation and see if it is a good investment based off its growth potential. I'll also share a price range that can help you decide if it's worth looking into KLAC further. Just a reminder, this isn't financial advice. And at the end, I'll also tell you the price I would personally be willing to pay. Currently, KLAC Corporation is the third largest company in the semiconductor equipment and materials industry, ranking behind ASML and Applied Materials, which we already looked at. KLAC specializes in supply of process control and yield management solutions for the semiconductor and related nanoelectronics industries. To simplify, their machines are looking for defects in products. Let's begin our analysis by looking at past performance, starting with revenue, which from 2009 to 2024 rose at 13.24% annually. KLAC had only 4 years of negative growth, otherwise the growth was always positive. For the gross profit margins, they are very high. They peaked in 2018 with 64%, but recently they're hovering at around 60%. Net profit margins are also expanding and they peaked in 2022 with 36%. They retracted slightly, but they are still very good at around 30%. The same applies to EBITDA margins, which are expanding, and cash flow from operations. Capex is also expanding, the same as for Applied Materials and ASML, and is taking bigger and bigger chunks of revenue each year. For KLAC, it peaked in 2021. Free cash flow, calculated on cash flow from operations and subtracting capex from it, it is also expanding its margins and are hovering at around 30%. Shares outstanding are decreasing, and we had some years where they were stagnant, but otherwise they are moving in the right direction, and they declined on average 1.5% annually from 2009 to today. Dividends are also expanding. They have a fall in 2016 and 2017, and the dividend payout is actually very healthy, recently at around 28%, with dividends per share being at $5.68, and with dividend growth being at 14.5% annually. Now, another important metrics for us is also relationship between EBITDA and cash flow from operations. Important it is that they are growing in the same direction, which for this company they do, and on average cash flow from operation is hovering at around 82% of EBITDA, with last being at around 82%. Also, this is very important for our later analysis. So now let's jump over to free cash flow from primary business to see if this company is profitable on its core level, and this is very important. To do that, we take net income, depreciation and amortization, and deferred income taxes and sum them together. Then we take capex and common and preferred dividends and subtract these two numbers from the previous sum, and with that we get free cash flow from primary business, which for KLAC is for the last 4 years positive, and average is 2.2 billion. Now we can already calculate the price from this number. To do that, we take 2.2 billion, multiply it with 20 and divide it with the shares outstanding to get $323. And now we can add in cash and subtract out debt to get $288. Now this is quite below the current stock price, which is at around 640. So let's continue with our analysis to see how other two metrics stack up and if the company is indeed so much overvalued or there is another story with different numbers. To do that, we'll project revenue for upcoming 3 years. Our first analysis is set at 0%. This is our baseline. This baseline is important to see how company stacks up at today's value if anything goes wrong. If you believe, of course, the company will grow in the future. If the revenue would decline, then 0% is not your margin of safety. For the average revenue, we'll take 8%, which is slightly below the recent year's average. And for the high, we'll take 12%, which is just shy of long-term average. For the net income, we'll use the profit margins of 26, 30 and 34%. For the EBITDA, we'll take 37, 40 and 43%, which is again based on historical averages, and cash flow from operation is calculated on percent I mentioned earlier at around 82% of EBITDA, and that gives us 30.4, 33% and 35.3. Then capex, as it is growing, I set it a little bit higher just to be on the safe side at 3.2%. Here are all our averages, and here are also analysts' numbers just for perspective. Now what we can do is the same as we did previously and calculate free cash flow. To do that, we take cash flow from operation and subtract out capex, and this gives us a 2025 numbers of 2.6 billion all the way to 3.5 billion on the highest side, with terminal value being calculated from 2027 number gives us a 32.5 billion all the way to 45 billion, with analyst numbers coming in at 58 billion. Now what we need to do is discount these numbers back to today, and to do that we'll use a discount factor of just shy of 11%, and this gives us adjusted terminal value of 26.4 billion all the way to 43.8 billion. And with these numbers we can already calculate our first perpetual growth rate range. To do that, we sum up all free cash flows and terminal value, which gives us a present value. And then, as we did previously, we subtract out debt and add in cash and divide with the shares outstanding to get our stock price range, which on the low side is at $212 and on the high side is $365, with our average being at around 289. With analysts' numbers, if they pan out with the same calculation, we get $394. So analysts are expecting quite higher free cash flow, which we can see here, and it is higher than anything we are projecting, just to keep that in mind. Now let's go over to our second analysis, which is EBITDA multiple. Here we take two numbers. One is company long-term average, which for KLA is at 13.05, and for the industry average, which is 22.19. So we can see that KLA is actually trading at almost 2 times lower EBITDA multiple than its industry peers. Now to calculate stock price, we take EBITDA 2027 numbers and multiply it with a given EBITDA multiple. And this gives us this terminal value range of 47.4 billion all the way to 77.3 billion for the company average, and from 80.6 billion all the way to 131.5 billion for the industry average. Then we again need to discount these numbers back to today, add in cash, subtract out debt to get our stock price range, which ranges from 247 on the low side and all the way up to $750, with our average being at 338 for the company average and 600 for the industry average, with analysts again having higher numbers because they already started with higher EBITDA numbers than we did, and they get $450 and all the way to almost $800. Now what we can do is average perpetual growth rate with EBITDA multiple to get an even better understanding of the stock price, and for the company average we get $229 for the lowest side and $395 for the high side. For the industry average, on the other hand, we get $328 on the low side and $557 on the highest side, with our averages coming in at 313 and 444. For the analysts, on the other hand, we already discussed, we get a higher number of $423.45 and $594.23. Now, based on this, what should you pay for KLA Corporation? Now, if you believe that the company will grow at a very slow pace and maybe even saw some declines in the future, then this stock price range is for you. Now, if you believe in a modest growth as it did, let's say, in the past 10 years, then these are the prices you should pay. And if you believe that it will grow more than 13 or 15% per year, these are the prices you should look at buying. Currently, this stock is not a buy for me, and I will show you my buy target for KLA Corporation. Now, before we do that, let's quickly recap why KLA is a good investment from the fundamental standpoint. Revenue growth, it is positive and it is very good at 13.24% over the last years. EBITDA and cash flow from operation growth matches at 82%, which is not as good as for the SML and Applied Materials, but nevertheless quite good, so 2 points for them. For the first time we have a company in this industry that has more debt than cash, but it is still not a bad result. They are averaging at around 1.69 debt per EBITDA, which is healthy, and debt is not an issue currently. Shares outstanding are going down at 1.48%, and free cash flow, very important point, it is positive for all 4 years we looked at, and they get 3 points for that. They also get some bonus points because of the dividends. For the dividend yield, currently sitting at around 0.88%, and dividend growth, they get 3 points as they are growing at very nice rate at 12.51%, and here we didn't take share repurchases into account. And dividend payout on average is 52%, but here we had that high number which actually pushed this number much higher. And if we delete that number, then our payout ratio falls to 37%, which is very healthy. And by that they get 16 points from 24 possible. Now let's jump over to my buying price, which is set at $350. This sets trailing 12-month PE at 14.71, which is far below last 5 years average, which is at 25 and very close to a low of 12. I set this price range as I believe that Applied Materials and SML are possibly a better investment. And as those two are a bigger companies in this sector, I believe KLAC Corporations deserves a little bit higher margin of safety if anything goes wrong. They are very good company, but for me, that is the price I am willing to pay. Next time we'll look at Lam Research to see how they stack up against other 3 companies. Thank you so much for watching, and I'll see you in the next video. Bye bye!